Thank you for taking the time to join us for our company's financial results briefing for the fourth quarter and full year of fiscal year 2025. I am Sogo, CEO of AnyMind Group. I will now proceed with the presentation. This slide summarizes today's presentation content. In the fiscal year 2025, driven by the growth of our core businesses, revenue, gross profit, operating profit, and net income exceeded our full-year forecasts. Gross profit increased by 17% year-on-year, with the enterprise growth business maintaining a high growth rate of 31%. This trend continued in the fourth quarter, with the enterprise growth business continuing to drive growth. Next, regarding the outlook for the fiscal year 2026, we forecast revenue of 79.1 billion yen, an increase of 38% year-on-year, gross profit of 30.3 billion yen, and operating profit of 3 billion yen, projecting an acceleration in profit growth. Even for organic growth excluding the impact of M&A, we project a solid increase of 22% in gross profit. In addition, we will accelerate initiatives to achieve our midterm targets by promoting sales activities and operational efficiency through AI utilization, expanding our business in the commerce domain, and strengthening relationships with regional clients. Next, I will share some highlights of our financial results. In the fourth quarter, both revenue and gross profit continued to grow year-on-year. For the full year, we maintained double-digit growth in both revenue and gross profit. In particular, the core enterprise growth business continued to drive this growth, with enterprise e-commerce growth performing strongly, centered on Southeast Asia. Regarding operating profit, while it decreased year-on-year due to changes in the external environment for the creator growth business, it improved compared to the previous quarter. Next, I would like to discuss the enterprise growth business, which is driving our growth. Centered on social media marketing and social commerce, this business has maintained a gross profit growth of 31% year-on-year. Backed by our support system that combines technology and operations, we are continuing to expand steadily, with a focus on the Asian market. Next, I would like to discuss productivity improvements and trends in SG&A. In the fourth quarter, headcount growth has been moderated compared to the previous year, and the increase in personnel expenses also remained limited. Driven by productivity improvements in the enterprise growth business, monthly gross profit per employee continues to improve on a basis excluding the creator growth business. We will continue to improve profitability through productivity enhancements going forward. Finally, I would like to discuss the progress of our profitability improvements. Profitability is improving, driven by sustained revenue growth and SG&A control. However, the quarter-on-quarter increase in operating profit was limited, as we conservatively recorded temporary expenses such as warehouse expansion and inventory provisions in the fourth quarter. In addition, due to the depreciation of the Japanese yen, we recorded foreign exchange gains as non-operating income, primarily from valuation gains on held foreign currency assets, and net income improved compared to the previous quarter. This is the summary of the consolidated financial results for the full fiscal year 2025. We exceeded the revised earnings forecasts announced in May 2025 across all lines, from revenue to net income. Operating profit was approximately 1.8 billion yen, and net income attributable to owners of the parent was approximately 927 million yen. While profits decreased year-on-year due to changes in the external environment, the results exceeded our plan. We plan to pay a year-end dividend of 2 yen per share as forecast. This is scheduled to be resolved at the Board of Directors meeting in early March. This shows the trend in financial performance by fiscal year. For the full fiscal year 2025, revenue increased by 13% year-on-year, and gross profit increased by 17% as we continued to grow centered on our core businesses. Operating profit was approximately 1.8 billion yen, and the operating profit margin was 3.1%. In fiscal year 2025, the enterprise growth business accounted for 73% of gross profit, the publisher growth business for 14%, and the creator growth business for 12%. The enterprise growth business grew by 31% year-on-year, driving our overall expansion and its share expanded from 65% in the previous year to 73%. While the publisher growth business remained stable, the creator growth business recorded a decline in revenue and profit year-on-year due to changes in the business environment. This is the performance by region. In fiscal year 2025, Japan and Korea maintained high growth across all businesses, driving the growth of the entire group. In terms of gross profit composition, Japan and Korea account for 51%, Southeast Asia for 38%, and China and India for 11%. The enterprise growth business, which is a focus area, is expanding steadily in each region, increasing by 28% in Japan and Korea, 41% in Southeast Asia, and 14% in China and India. This shows the trend in financial performance by quarter. In the fourth quarter, revenue increased by 9% year-on-year, and gross profit increased by 11%. The growth trend continued, centered on the enterprise growth business. Operating profit for the fourth quarter was 535 million yen, a decrease year-on-year. While profit increased quarter-on-quarter, the extent of this increase was limited due to the impact of temporary expenses, such as capital expenditures for efficiency improvements and inventory provisions. Adjusted EBITDA was 1.1 billion yen, a decrease of 123 million yen year-on-year. Here are the factors contributing to the change in operating profit compared to the previous quarter. While personnel expenses remained roughly flat, IT expenses increased as variable costs due to an increase in e-commerce platform fees driven by the expansion of e-commerce sales. In addition, other SG&A increased due to higher logistics-related expenses and promotion costs associated with the expansion of the enterprise e-commerce growth business. This shows the quarterly trend for SG&A. The ratio of SG&A to gross profit in the fourth quarter remained roughly flat. Going forward, we will continue maintaining discipline over SG&A by boosting operational efficiency and moderating increases in personnel expenses. Gross profit per employee, a key indicator for measuring profitability improvement, is steadily improving on a basis that excludes the creator growth business, which faced a changing business environment. Furthermore, while headcount increased due to M&A and personnel investments in the enterprise e-commerce growth business, we have successfully kept this increase significantly below our initial plan. In the fourth quarter, we raised additional interest-bearing debt to fund M&A activities. The total goodwill from the 12 M&A deals executed by 2025 amounts to approximately 3.8 billion yen. The ratio of goodwill to net assets stands at 0.23 times, maintaining a safe level. Even taking into account the impact of the 3 M&A deals conducted in January 2026, we continue to maintain a sound financial foundation. I would like to explain the performance by business segment. In the fourth quarter, within the enterprise growth segment, the marketing business grew by 10% year-on-year, and the D2C e-commerce business grew by 81%, continuing to maintain high growth. The publisher growth business also remained stable, increasing by 7% year-on-year. While the creator growth business declined year-on-year due to changes in the external environment and a review of our focus areas, the company-wide gross profit margin remained generally stable, supported by the growth of the e-commerce support business within the enterprise growth segment. In the fourth quarter, the marketing business achieved stable growth, with gross profit increasing by 10% year-on-year. While the growth rate has been lower due to resource allocation to the high-growth e-commerce support area, we expect the growth rate of the marketing business to recover in fiscal year 2026, driven by a strengthened sales structure. In the full fiscal year 2025, the marketing business achieved gross profit growth of 18% in Japan and Korea, 18% in Southeast Asia, and 15% in Greater China and India. Influencer marketing achieved solid growth of over 20% across all regions. Regarding sales composition by client industry, while cosmetics and beauty is the largest sector at 26%, our portfolio remains well diversified, allowing us to serve a wide range of industries. In terms of client attributes, Japanese companies account for 40%, non-Japanese global companies for 37%, and local Asian companies for 24%. We continue to build a well-balanced client base. The number of active clients in fiscal year 2025 exceeded 1,500, with revenue expanding alongside the year-on-year increase in customers. In the fourth quarter, the D2C e-commerce business grew by 81% year-on-year. The enterprise e-commerce growth business remained strong, achieving growth of 162%. Continuing from the third quarter, Southeast Asia is driving this growth. In addition to the contribution from the consolidation of Bibula in Vietnam, organic growth was strong in Vietnam, Indonesia, the Philippines, and Thailand. The business is also expanding steadily in Japan. Please note that while the overall gross profit margin for the business is trending downward, this is due to the steady expansion of the enterprise e-commerce growth business, and there were no significant changes in the profit structure of each businesses. The number of brands for creators remained generally stable throughout fiscal year 2025. D2C brands by our exclusive creators performed well, driving growth in sales per brand. In the enterprise e-commerce growth business, the total number of brands handled increased due to new client acquisitions, primarily in Southeast Asia, and the consolidation of Bibula. Furthermore, revenue per brand grew, driven by the expansion of project scale across all regions. I would like to introduce a case study of Advanced Clinicals, a US beauty brand, as an example of our comprehensive support leveraging TikTok. Through our support, we successfully drove a 26 times increase in sales in just 1 year from the launch. The key to this success was leveraging the demand generated on TikTok to drive sales not only on TikTok Shop, but also across other e-commerce channels like Amazon and Rakuten, as well as physical stores such as Loft and Plaza. We believe this is a highly reproducible success model that only we could achieve, enabled by our ability to provide end-to-end support for all operations, ranging from strategy formulation to shop management, logistics, inventory control, and customer service. I would also like to explain the physical infrastructure that underpins our live commerce business. We operate a total of 65 dedicated live streaming studios across Asia, including Japan, Vietnam, and Thailand. For example, in Thailand, more than half of the sales on TikTok Shop are generated through live streaming rather than video posts. To meet this significant demand, we have established a structure that allows us to respond immediately using our own resources without relying on external infrastructure. Shown on the right is a case study of our AI live platform, AnyLive. By implementing the AI-powered AnyLive, an insurance client successfully achieved continuous long-duration live streaming while simultaneously reducing their internal operational burden. Gross profit for the partner growth business decreased by 26% year-on-year, while gross profit for the creator growth business decreased year-on-year due to changes in the business environment. The publisher growth business achieved stable growth. Looking at the results by region, in the creator growth business, Southeast Asia and Greater China and India recorded negative growth due to the impact of changes in the business environment, whereas in Japan, we achieved growth driven by the progress of business diversification. In the publisher growth business, we achieved positive growth in Japan and Southeast Asia. From the third quarter to the fourth quarter, we tightened our qualification standards to improve profitability and unit price levels per media. Consequently, the number of publishers decreased, primarily in Greater China. While ad unit prices remained sluggish overall, gross profit per publisher is trending upward, driven by the expansion of high-value ad initiatives such as video or apps, as well as increased revenue from proprietary media through AI utilization. As a result, this business has achieved stable growth. Here, I would like to explain the growth opportunities in the publisher growth business. First, leveraging our global publisher network, we are jointly designing highly profitable proprietary ad formats with media that possess ad inventory, such as web media. We also have a robust network of advertisers and agencies with marketing needs. By leveraging this network to directly match the demand and supply sides, we enable efficient revenue generation. Furthermore, this product development and proposal process is underpinned by our proprietary platform, allowing us to consistently maximize revenue with high reproducibility. In this way, by leveraging our strengths in publisher and advertiser networks, as well as technology and data utilization, we continue to expand revenue together with our partners. In the creator growth business, the number of contracted creators has decreased as we scaled back the support scope in the short-form video area and reviewed our focus areas to prioritize synergies with the enterprise growth business. I will explain the details and future direction regarding this later. Furthermore, revenue and gross profit per creator increased, driven by the recognition of temporary revenue such as copyright-related revenue. I would like to introduce examples of our expansion into medium to long-term growth areas and synergy creation within the creator growth business. Shown on the left is Geo by Seiju, a new academy label we have launched within the talent management business. While our existing production label, Seiju, enjoys high popularity, this new label specializes in the discovery and incubation of new talent. Leveraging the expertise we have cultivated, we will build next-generation talent capable of succeeding in various fields. Shown on the right is a case study of the YouTube Shopping Affiliate Program. In Indonesia, we support over 100 creators who have strengths in the commerce sector. In the second half of 2025, 3 gadget review YouTube channels each achieved a monthly GMV of over $100,000. I would like to reiterate our midterm financial targets for fiscal year 2027. We are targeting revenue of 105 billion yen, gross profit of 38.5 billion yen, an operating margin of 6%, and an operating profit of over 6.3 billion yen. There are no changes to these targets, and we aim to achieve them by accelerating the growth of existing businesses and executing strategic measures. Specifically, we will proceed with accelerating growth of existing businesses, centered on the enterprise growth business, expanding the social commerce domain through the reorganization of our publisher and creator networks and strategic M&A, improving profitability by enhancing sales and operational efficiency through the use of generative AI. By steadily executing these measures, we aim to achieve our midterm targets. I would like to outline the enterprise growth business, which is our key focus area. A defining feature of our enterprise growth business is the integration of social media marketing and social commerce. Especially in environments where social media and e-commerce are integrated, such as TikTok Shop, it has become common for products trending on social media to lead directly to purchases. Consequently, the seamless connection between marketing and commerce is becoming increasingly important. Furthermore, the importance of social media marketing is growing, including the utilization of influencers and commerce creators, as well as creative operations tailored to specific platform characteristics. Our strength lies in our ability to provide these as an integrated solution across all of Asia. This slide illustrates the synergies between our social commerce and marketing businesses. Currently, we support the e-commerce operations of 220 brands. This area serves as a solid revenue base that generates recurring revenue, which is why we are prioritizing investment here. By supporting e-commerce operations, we also expand opportunities for marketing support, enabling us to provide comprehensive support for brand growth. In the marketing domain, we have a client base of over 2,500 companies. Leveraging this network allows us to further expand our e-commerce support business. Furthermore, utilizing e-commerce and customer data enables more precise marketing initiatives. This creates a virtuous cycle where generating trends on social media leads to sales expansion and further data accumulation. We will further expand this cycle to enhance the value we provide to brands. Our competitive advantage lies in our integrated structure combining data and products, operations, and sales. By leveraging social media, purchasing, and creator data, we provide end-to-end support, ranging from influencer marketing to e-commerce operations and performance measurement. Furthermore, we have the operational capacity to execute over 10,000 marketing campaigns annually, while also supporting e-commerce and live commerce operations. In addition, with a sales force of over 500 people across 15 Asian markets, we can provide marketing and commerce support on a cross-regional basis. There are very few companies in Asia with a structure that combines all these elements, and this is what gives us our competitive edge. We provide both technology and operational support. Considering the current development phase of the Southeast Asian market and the shift in business models driven by AI, we believe this integrated model itself is a key competitive advantage. We are currently optimizing our internal operations by leveraging AI, while simultaneously continuing to update our products. This allows us to build a structure capable of responding flexibly and swiftly to changes in the business environment. This slide explains why we view the evolution of AI not as a risk, but as a catalyst for accelerating our growth and improving profitability. As AI evolves, differentiating through standalone software becomes increasingly difficult. On the other hand, the competitive advantage grows for companies that possess the operational infrastructure to actually execute tasks, as well as the sales and operational capabilities to deploy across various countries. We have already established an integrated structure combining data and products, operations, and sales. Our strength lies in our ability to rapidly incorporate AI into our actual workflows and service improvements. In the short term, we see significant opportunities for operational efficiency and cost reduction within our existing operations. We expect the use of AI to drive improvements in profitability. In the long term, by leveraging our integrated data and execution capabilities, we plan to enhance our AI-driven products and services. We believe this will allow us to further solidify our competitive advantage across Asia. This slide explains a key point in our fiscal year 2026 business operations and budget, the restructuring of the support areas within the creator growth business, including the negative impacts. To give you the conclusion first, while certain creators currently contribute to revenue, we have decided to scale back our support for them. We made this decision due to concerns regarding their medium-term profitability, growth potential, and revenue stability, as well as the difficulty in foreseeing stable revenue expansion from the perspective of synergy with the enterprise growth business. This restructuring is intended to optimize resource allocation and avoid a gradual decline in future revenue or the creation of excessive uncertainty. Specifically, we are reviewing our support structure, which was centered on short-form videos, to concentrate on areas capable of creating value within the social commerce domain. As a result, the number of supported creators has been reduced from approximately 2,100 at the end of the third quarter of 2025 to 1,237 at the end of the fourth quarter. Contracts with creators who are no longer subject to support were terminated in the fourth quarter, and we have fully factored in all potential impacts. Our criteria for selecting which creators to support were based primarily on 3 points. First, limited potential for creating synergy with the enterprise growth business. Second, difficulty in expecting medium-term revenue growth and stability. And third, low alignment with the quality and growth areas we prioritize. Going forward, we will strengthen our support for talents and creators who have a high affinity with brands and product categories, commerce creators influential in driving e-commerce sales, and live streamers with strengths in live commerce for creating synergies with our other businesses. Regarding the financial impact, the effect on fiscal year 2025 has been limited. For fiscal year 2026, due to the reduction in supported creators, we anticipate a decrease in operating profit of approximately 500 million yen compared to if we had continued these operations unchanged. However, this has already been factored into our earnings forecast. That said, driven by growth in our focus areas and expanded synergies with other businesses, we expect to see an increasing and continuous contribution to revenue from 2027 onwards. Here, I would like to explain the publisher and creator network that underpins our social commerce support. As I explained on the previous slide, while we are refining our focus within creator support, the network itself remains a vital competitive advantage for us. Currently, we support 1,171 publishers and 1,237 creators across 15 Asian countries and regions. This network serves as the foundation for our support for enterprise brands. Our strength lies in our ability to combine media, creators, and commerce to support not only ad revenue, but also monetization that leads to actual purchases. Going forward, we will continue to expand our support for enterprise brands by linking this network with the growing field of social commerce. Next, I would like to explain how the 3 M&A deals executed in January 2026 complement our social commerce support structure. Their roles are simple: MISM handles demand creation, B-code drives purchase conversion, and SunSmile is responsible for distribution expansion. With these additions, we have establishing a structure capable of providing end-to-end support ranging from social media-driven demand creation to purchase conversion, and e-commerce and offline distribution. Previously, we focused on creating demand via social media and providing sales support centered on e-commerce. Through these M&A transactions, we are expanding our capabilities to provide end-to-end support that includes video production, live streaming, e-commerce, and even offline distribution. First, MISM is a creative platform focused on vertical video. In social commerce, videos that create awareness and interest are essential. With MISM joining us, we have strengthened our ability to provide a stable supply of high-quality video production. In addition, by leveraging their model network and asset management system, we are building a creative supply structure that brands can use with confidence. B-Code is a creator management company focused on live streaming. Live commerce offers high conversion rates from viewing to purchasing, making it a critical channel for driving purchases. Through this partnership, we will leverage B-Code's network of live streamers to strengthen our purchase-driving capabilities in live commerce. By coordinating with our creator growth business, we aim to achieve further growth. SunSmile is a brand distribution company centered on the cosmetics and beauty sectors. Its strength lies in its ability to expand demand generated on social media and e-commerce into offline distribution channels, such as variety stores. Even in the short term, we anticipate direct synergies, such as cross-selling, with the brands we support. This is our full-year earnings forecast for FY 2026. We forecast gross profit, our key metric, to increase by 38% year-on-year. This forecast incorporates the financial results of the 3 M&A deals executed in January 2026. We project an operating profit of approximately 3.1 billion yen, a 70% increase year-on-year, and expect the operating margin to improve from 3.1% to 3.9%. We would like to highlight that we have entered a phase where profitability is improving alongside growth. Regarding dividends, we plan to maintain the same level as the previous fiscal year, at 2 yen per share for the year-end dividend. For this fiscal year, we intend to prioritize capital allocation for growth investments. Next, I will explain the assumptions underlying our earnings forecast. First, regarding gross profit, we anticipate that the marketing and D2C e-commerce businesses will continue to drive growth. In the publisher and creator domains, we are prioritizing profitability in our operations and proceeding with restructuring from a midterm perspective. We view this as a turning point toward achieving stable growth accompanied by quality. On the cost side, while personnel expenses remain our largest cost, we do not plan to increase headcount at the same rate as sales growth. Consequently, our assumption is that profitability will improve gradually. We also see the potential for even greater improvements in personnel efficiency than currently budgeted, driven by operational enhancements through AI. Please note that the effects of future M&A are not included in this forecast, and we consider them as potential upside. There are 3 key strategies underpinning our growth in 2026. First, operational efficiency through AI utilization. We will integrate AI into every process, sales, production, and operations, to simultaneously enhance productivity and the value we provide. Second, the business expansion in the e-commerce and commerce support domains. Leveraging our presence across 15 markets, we will accelerate cross-border transactions and establish a one-stop support structure for social commerce in Asia. Third, deepening relationships with regional clients. For brands operating across multiple countries, we will provide integrated solutions ranging from marketing to e-commerce, thereby maximizing LTV. This slide shows specific examples of our AI initiatives and operational improvements. Even within the same marketing business, operating profit margins vary significantly by country. In our most profitable markets, we achieve margins of around 15%. Currently, we are standardizing the operational processes used in these high-profit markets. By combining this with AI-driven automation, we are working to improve efficiency across all countries. We believe that the accumulation of these steady efficiency gains will serve as the foundation for future improvements in profitability. This concludes our presentation. Thank you for your attention.